Hey everyone, so why is everyone talking about ZIM stock? Well, in my opinion, I think it's because of the incredibly cheap valuation. ZIM stock is one of the cheapest stocks in the market today. It's in fact one of the cheapest stocks that I follow in my entire range of stocks. Trading, if you look at from a price to free cash flow metric, is trading at a price to free cash flow of 0.363. That's really cheap. You're scarcely able to find companies trading at these low valuations. Now, there is a reason why the stock is trading at this low of a valuation, and I'm going to get into that for the bulk of this video. But before I do that, let's look at the path the stock has taken, right? In July of 2021, it was trading at a price to free cash flow of over 3, so nearly 10 times higher than where it's trading at today. But the business was in a totally different position in July of 2021 compared to where it is today. Right? The prospects were incredibly good in July of 2021. Shipping rates were extremely high. Demand for shippers was extremely high. So the business was in a completely different position than today when it's the flip side of the boom times. So let's get into the details. Let's look at why the stock is trading so cheaply and why this cheap valuation is justified, or is it an opportunity? So let's take a closer look. So the big thing here, and this is from the CFO of ZIM, Executive VP and CFO, saying on average their freight rate per TEU in the most recent quarter was $1,390. That was a 64% decrease year over year. And I imagine a bigger decrease year over 2 years. So 2 years ago, this rate was significantly higher. Then last year it decreased, and now this year it decreased further. So it's on a steady decline, and it's fallen more than where it was pre-pandemic. So there is room for this metric to rebound because it's fallen so low right now. And because of this decrease in shipping rates, the company's in a difficult position. Revenue in the first quarter fell to 1.4 billion. This is a typo saying 14. It was actually 1.4 billion compared to 3.7 billion last year due to this dramatic decrease in freight rates. And so that caused the company's total debt to increase by 307 million in the first quarter. And but they currently operate 152 vessels, 138 container ships, and 14 car carriers. So they have planned ahead. They did understand that the boom times were not going to last forever, but it's difficult to cut costs in this kind of business. It's difficult to cut costs. A lot of your expenses are fixed expenses, and so when revenue declines, there isn't much you can do. I mean, you can scrap a few ships here and there, but that may not make sense. So you've just got to build up your cash position, which ZIM did, and just weather the storm. So in the short term, we expect the number of vessels we operate to remain fairly stable, right? You can't, what can you do with the vessel? You either scrap it or you keep it. Yet we will grow our operated capacity with the delivery of cost-efficient new builds and the redelivery of smaller, less cost-effective tonnage. So they're shifting their mix of ships. The new ships that they're investing in, they're more cost effective, and as those come in, their cost per TEU is expected to decline. So the first quarter results were driven by their disproportionate exposure to the Trans-Pacific trade. And if you've been following macroeconomic factors, you will have realized that consumers are spending less on goods and they're spending more on services. And when consumers spend less on goods, that means there's less imports from Trans-Pacific areas, and that's been bad news for ZIM. So in the quarter, they carried 769,000 TEUs, and that was a 10% decline compared to the same period the year before. So not only are they experiencing the 64% decline in the price per TEU, but they're also experiencing a 10% decline in the number of tonnage shipped. So a decrease in the quantity and a decrease in the price. A big downward trend for ZIM. And fortunately, management said they expect improvement in the second half of the year. That remains to be seen, but management is optimistic. They have plenty of cash on hand to weather the storm. They saw this coming, and so they're not in a very dangerous position to run out of cash or anything like that. It's just going to be tough for the next couple of quarters as the industry rebalances itself, gets itself back into equilibrium. And longer term, there is going to be a decrease in shipping because there is a lot more of onshoring that's happening. Companies in the US are not excited about having their supply chains over in Asia anymore because they saw how it could be disrupted, and to decrease risks they're onshoring some of their supply chains, so that could have a decrease in shipments longer term, but not anything dramatic like we're seeing in the last couple of quarters. So it remains to be seen where this industry will end up in equilibrium, but right now it's on the downside following a boom time during the pandemic. All right, so I hope that sheds some light on why everyone is talking about ZIM stock, mostly because the stock is so cheap and a lot of people are kicking the tires looking at if it's a good buying opportunity or not. If you're interested in a video explaining that, I will have more coming on whether or not ZIM stock is a buy at these prices. Thank you so much for watching. I hope I'll see you again soon. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.